Hi, everybody. This is Alan Elman, the Blue Collar Investor, and welcome to this BCI podcast number 128, titled Holding a Stock Through an Earnings Report. We're going to be using a real-life example with Atlassian Corp, which trades on the NASDAQ exchange under the ticker symbol TEAM. Now, in our BCI methodology, we have a very important rule, the earnings report rule. And that states that we should never, ever have an option in place that expires after a scheduled earnings report. The reason for that is that report can disappoint, and it could cause a precipitous drop in the price of that security. It also can be much better than expected, and that could cause an exponential rise in share price. So if we decide to hold on to the stock through the earnings report, why cap the upside? Now, if we happen to have a lot of confidence in that stock, perhaps it has a history of beating expectations or consensus, we can hold the stock through the earnings report and then sell the covered call option after the report passes. Now, here's the dilemma with Team at the time that I made this video and podcast. There was a covered call in place, and this was taken from, by the way, the portfolio of one of our premium members. There was a covered call contract in place expiring on October 18th, 2019. The earnings report was due out on October 17th. So the earnings report was before the contract expiration, which would break the BCI rule regarding earnings reports. So what do we do? Well, if we were to take a look at the price chart of Team in November of 2019, we would see something very interesting. And for those of you that are also watching this podcast, you can look at the chart in front of you. For everybody else, I'm going to describe it. Now, Team was an uptrending stock through the end of August 2019. Then it slightly declined and went into a sideways consolidation. Now, here comes the earnings report. And the earnings report, of course, showed a huge spike in volume. Those of you watching this podcast, you'll see that on the bottom of the screenshot. And the initial reaction was for the price of the stock to decline precipitously. Lo and behold, after that decline, it immediately rose exponentially. What the heck happened here? Well, I found an article in Investors Business Daily regarding earnings expectations of software companies like TEAM. Now, in this particular case, the report showed that earnings rose an amazing 40% year over year, and revenues climbed just as an impressive 36%. So why the heck did the price of the stock initially decline? Well, what happened was the market had what I wrote down here, illogical expectations. And even though the report was amazing in a favorable way, the knee-jerk reaction was for the price to go down. But then reality set in, and investors realized, wow, this is a great company with a great earnings report, and it immediately recovered. Now, the reason that I'm bringing this particular situation to view here is because it shows you the risk involved with earnings reports. Even with an amazing earnings report like this one, the price of the stock still initially declined. So we don't want to take the risk of earnings reports with our covered call positions, or even for that matter, with our put selling positions. But there are some times when we have a lot of confidence in a security and we want to hold it through the report, in which case not capping it with a covered call will allow for share appreciation if it does in fact beat consensus. So in a particular case like this, what I would have done was I would have removed the short call let the report pass, and then write the call after that recovery. Let's summarize now. When we have a long-term bullish assumption on securities about to report earnings, we can hold the stock through the report and start selling options after the report passes. So those are our two options. We can either not have the stock in our portfolio or retain that security, but not write the call until the report and the volatility post-report subsides. Now, in cases like with Team, when there are weekly options available, we can sell weekly options that contract month and just skip the week of the earnings report. So for example, if it were a 4-week contract and the earnings came out in week 3 of that 4-week contract, we could start by selling a 2-week option, skip week 3, and then sell an option on the 4th week. And then from there, we can continue weeklies or move to monthlies after the report passes. Once again, the rule is never have an option in place that expires after a scheduled earnings release. Now, most of the time, that is going to work out well for us. So I would adhere very closely to our BCI earnings report rule. As I always do, I'm going to mention to everybody our BCI package, our best and most comprehensive educational product ever offered by the blue collar investor. There are 18 components to it, and one of those components have an additional 200 components to it. There are 6 online video courses with downloadable workbooks, 6 calculators created by the blue collar investor, found nowhere else, 5 of our best-selling books on both calls and puts in ebook format, and our 13-month annual premium membership, which includes a huge educational component of over 200 training videos, along with many other perks. You can find out more information about our BCI package by going to our website, www.thebluecollarinvestor.com. Click on the link at the top that says BCI package. You can also purchase all of our products individually at our store, www.thebluecollarinvestor.com/store. Ladies and gentlemen, I want to thank you very much for taking the time to watch and or listen to this BCI podcast number 128, Holding a Stock Through an Earnings Report. Folks, I hope you enjoyed this presentation, and more importantly, I hope it puts cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.